Welcome to this short yet in-depth video tutorial on using discounted cash flow to value a business or almost anything that generates a cash flow stream. There are three approaches to value a business. The income approach, which values a company based on its future streams of cash flows and profit. Then there is the market approach, which is also a very common approach as it involves comparing a business that you want to value against the valuation multiples such as P ratio, price to book ratio, and price to sales ratio, which you can get from public listed companies' data or past transaction records. The last method, which is not as popular as the other two, requires one to value the tangible and intangible assets and liabilities of a company. This is definitely much more complicated and time consuming. That's why it is less used. The discounted cash flow method, or the DCF method, falls under the income approach. Why we need to learn about this? Because it is economically sound and it is widely used by the valuation and investment community. The objective of this tutorial is to learn how to value a business based on free cash flows that it can generate. Remember, for a business, it is free cash flow that matter most. Even companies that are generating negative cash flows will need to gain positive cash flows sooner or later, or you run out of cash and go bankrupt. We will not cover how free cash flow is calculated here. If you're interested, you can refer to other tutorials. Let's first understand the concept of discounted cash flow. Okay, suppose you have a business that is forecasted to generate $100 cash flows for 3 years only. Okay, it doesn't have any other cash flows, only 3 years. So for year 1, it will generate $100, year 2, 100, and year 3, 100. So what is the value of these cash flows? Some will say, isn't it easy, just add up 100, 100, and 100 from these 3 years, it gives you 300. So the value of the money is 300. But is this correct? The answer should be no, because you think an investor that put in a business would expect certain kind of return over these 3 years. So given a business that is considered much more risky than, say, a fixed deposit, the investor would expect a higher rate of return from this business, right? Then he put the money in a fixed deposit, for example. So assuming that the expected return is 25%, then we will call it the discount rate is at 25%. So the discount rate is the rate of return the investor will need. So if the investor expects a 25% per year and the discount rate is 25%, to get a discounted cash flow for the end of year 1, it will simply be what? Okay, will actually be $100 divided by 1.25 to give $80, because $80, if you invested at 25% return, you will get back $100, right? You will get back $100. Okay, so what you do is that you take 100 divided by 1.25, you get $80, and if $80 you times 1.25, you get back $100. Okay, what's the concept. Okay, so for year 2, okay, the present value of $100 is actually 64. How do you get that? Because if you think about it, right, $100 you need to divide it by 1.25 twice. So $100 divided by 1.25 give you $80, and then 80 divided by 1.25 gives you 64. So the present value of $100 in year 2 is actually $64. Or the other way you think about it is that $64, if you invest it at 25% for 2 years, you get back $100. Okay, so the principle is the same for year 3. So it's just $100 divided by 1.25 3 times, you get $51. So you can see the value of $100 diminishes from $80 to 64 and then to 51 over a period of 3 years. Okay, so the same $100 is worth less and less to the investor as time progresses. This is called the time value of money, and that's the effect of discount rate. So the riskier the business is, the higher the discount rate is required. So for example, a big public listed bank, okay, like would definitely have a lower discount rate than say a startup. Okay, so that is the difference. And the undiscounted cash flow is simply the addition of this tree is $300, correct? But the net present value of cash flow, which is also equivalent to the discounted cash flow, is actually only 195, which is 80 plus 64 plus 51. The earlier example assumes the cash flow from year 1 to 3 is similar at $100. However, in reality, most businesses will forecast cash flows that vary from year to year. Furthermore, most likely they will forecast a growing cash flow. In this example, the year 1 cash flow is 100, but it grows to 150 in year 2 and $200 in year 3. And assuming the discount rate is still at 25%, we apply the same formula as the earlier example. Okay, and so what you get, $100 divided by 1.25, you get $80 still. But what about year 2? For year 2, if you divide 150 by 1.25 twice, okay, you will get $96. So it's like 150 divided by 1.25, and then you get 120, and 120 divided by 1.25 get 96. All right, so for year 3, you will divide it $200 by 1.25 three times, and you get $102. So you can see from this chart here that actually year 3, the discounted cash flow for year 3 and year 2 is almost the same, because year 3, the growth rate is much lower at 33.3% compared to year 1, which is 50%. So when the rate of growth slows down, the discount factor is quite big, and you could get a discounted cash flow value that is similar or even lower than the previous year. So the undiscounted cash flow here in this case is 100 plus 150 plus 200, which is 450. But the net present value of cash flows, which is basically adding up the $80, 96, and 102, is 278. However, a business typically doesn't end after 3 years, right? In fact, most cases in DCF, we assume that a business will last perpetually, unless there are reasons to believe otherwise. So like in the earlier example, we have the cash flow from year 1 to 3, that is 100, 150, and 200. But now, in year 4, we grow it at only 5%. So the year 4, okay, we assume that it will grow at 5% in perpetuity, or that's forever. And so the year 4 cash flow is 210, which is 200 times 1.05. So year 5 will be 221, and year 6 is 232, right, which is basically just growing at 5%. Okay, then we continue to have this cash flow growing at 5% in perpetuity. That's our assumption here, right? The simplifying assumption that the cash flow will continue to grow at 5% in perpetuity. And so, how to get this discounted the value of this cash flow? All right, to get the value of these cash flows that grow from year 4 to perpetuity, we use, it is called terminal value as well, and we will use this formula whereby you take the year 4 cash flow, which is 200 times 1.05, then you divide it by the discount rate minus the perpetual growth rate, which is 5%. All right, so you get 1050, and then to discount it, you discount it by 3 years because it starts from year 4. So basically, you will discount it 3 years to year 0. You get 538. So the value of the business in this case will be simply 278 plus 538, which is 816. Okay, so the value of this business to generate this kind of cash flow will be 816. So this is the end of the tutorial. If you'd like to find out more, please visit our website, vivianpolis.com. Thank you.